Okay, this is Business 436, the Gordon Biersch case. And just real quick, there's three different documents that Professor York had for you guys as kind of how to do this. One was on actually Polylearn. This is what he had in the description where the assignment was listed on Polylearn. I'll send you a copy of this. You can read it yourself, and it just talks to you about how you're supposed to do it. You're supposed to do it from the point of view of Dan or Dean, so it's a memo from Dan to Dean or Dean to Dan. We did Dan to Dean in this case. But you can go through this stuff. No need for me to really go over it, but I'll send it to you. Also on Polylearn, he had this download. Same thing, some do's and don'ts about a case write-up. Again, you can go through this. I'll send it to you in an email. And thirdly, this is on Polylearn and just says some questions you should be asking yourself. Again, I'll send this to you. No need for me to go over it with you on this video. Okay, so then the actual case write-up. Again, I'll send this to you so you can read through it. No need to spend time on it on this video. The only part that I'm going to spend time about, this is 3 pages. The third page talks about some of the numbers. And this, we'll go through this, and there's a couple exhibits. I don't know if you want to call them exhibits or addendums. I can change them if you want. I call them exhibits because in the case file, the stuff that they had listed was called exhibits, so I call these exhibits too. Okay, so the Fertittas are going to fund all 11.2 million at a post-money valuation of 42 million, which means the pre-money valuation was 42 million minus 11.2, so 30.8 million. And based on the number of shares they had, there was like before the investment, there was like 198,000 shares outstanding. Okay, and that worked out to $155.08 a share, just like what they're purchasing in at $155.08 per share. Okay, so it said that this $11 million would give them a 26.67% ownership up front, and that's just $11 million they invested divided by the valuation of $42 million, so they would have a 26.7% ownership. It said that in addition, they wanted to get majority control by buying $7 million of stock from the existing stockholders. In the case, it said pre-money valuation. Of course, the pre-money valuation was post-money valuation minus the investment, so 30.8 million. Which, if you take the $7 million investment or buyback, they're going to buy back stock of existing shareholders so that they own more shares, basically. Take that 7 million and divide it by 30.8, and you get 23%. The problem is, one way or the other, this it doesn't work out. You would think you could just take the 26.67% ownership they bought and the 23% ownership they're going to buy, and that adds up to roughly 50%, which gives them majority interest. But depending on how you do it, either way you do it, and I'll show you an example of it, one of these purchases dilutes the other. So if you do say the 23% up front and then buy the 26.67%, this ownership adds more shares, so it dilutes that 23% down to like 17%. Vice versa, if you buy the 26.67 up front and you then buy the 23% of the whole after that dilutes this down. So I can't get to the 50%. I don't know how he's figuring that. Maybe I'm just not getting it, but anyway, you know, if he brings that up because that's how your worksheets are based, you'll just say you couldn't figure out how to get it to 50%, even though you did these two things. You bought the shares, $7 million worth of the shares at $155.08 per share, which is the pre-money valuation per share price, and you bought the 11.2 million shares. I mean, $11.2 million at the same price, $155.08. Okay, so basically, and then they want each, remember, I've written this as a memo from Dan to Dean. So the part of it starts off Dean, because this is Dan writing this, right? So Dean, and it ends with at the bottom saying, let me know your thoughts, and then Dan, and you might want to sign that or you don't have to. But anyway, so this is supposed to be a memo from one guy to the other. And that's the way it's worded. Okay? So it says in order to make this deal work, we have to convince all the remaining shareholders, because remember, they don't want Dan or Dean to go below about 16% ownership. So that means that the rest of the shareholders are going to have to sell their shares to the Fertittas for that $7 million, for the additional shares that they want to purchase. So in order to make that deal work, you're going to have to convince the remaining shareholders to sell the same proportion of their existing stock. So they're all going to have to sell like 20% of their stock or 23% of their stock, whatever it is, or more than that, except for Dan and Dean. And of course, the Fertittas aren't going to sell their share of it either. So they're all going to have to sell the same proportion of their stock. And it shows what it'll look like in Exhibit 1 after the $7 million buyback. But the point to stress to the current investors is even though they'll have a lower ownership percentage, the funding will help us reach our growth goals, making the overall value of their ownership grow significantly. And that'll be Exhibit 2 that we'll go over. And basically it talks about how Exhibit 2 is based on if you look in the case, there's a pro forma income statement for 1995 through 1999. So I use their numbers from that pro forma to figure out what the earnings per share would be, and then the earnings per share and the PE ratio, and then the total valuations of everybody's stock shares that they have left from 1995 to 1999, what they would be worth. And so the idea is, even though they have less shares, the value of their shares goes up a lot with this growth. And so overall, they'll be wealthier because of it. And that's what you want to convince them. So here's the two exhibits. This is the first one. And this basically shows, this is pre-money. So this is how many shares and options each investor have. And some of these guys, they call them investor 1, 2, 3, 4. So I just copied this out of the case. This is their fully diluted ownership, which means their shares plus options per person. Okay, so then after the Fertittas investment, remember the Fertittas are going to invest, let me back this up just a little bit. The Fertittas are going to invest $11.2 million. So the post-money valuation is going to be $42 million. They're buying 72,220 shares. So originally, if you added these two, the shares and options, that was 198,604, plus the 11,200,000 investment that they're making. That's the price per share. Okay, and that's basically based on the easiest way to figure out originally was to there's two ways to figure it out. The pre-money valuation was 30,800,000 and there was 198,604 shares. So that's $155.08 a share. Or since you knew that they were investing 11.2 million, post-money valuation is 42 million. That tells you that they're buying 26.67% of the stock, which means the original shares were 63, something like that, 63%. So you take this divided by 63%, 0.63, you get 270,000 shares. Subtract these two, and that's how many shares they bought. You could figure that either way. But this is how many shares that they bought. So if you have to keep your ownership the same, well, this is just the number of shares that they all had plus options. So it added up to 270,824. And then this is the ownership, which is just either dividing the shares by the total number of shares or the value by the total number of total value of the company at the time. And remember, this is just their share numbers times $155.08 per share. Okay, so at this point, they own 26.67% of the company. Now, to buy the other shareholders out, Remember, they don't want Dan or Dean. I got this as Dan Gordon, and this is Dean Biersch. Glad I caught that. Okay, so I'll have to change that. So anyway, they don't want these guys to get lower than 16% roughly. So the purchase of the $7 million worth of shares that they were going to buy at the same valuation, so $155.08 a share, means that they're going to be buying another 45,137 shares. Those shares have to come out of these shareholders, not Dan or Dean, and of course not out of the Fertittas, so it's going to have to come out of this guy's shares. So we're just going to make it, whatever these guys' shares are. I forget the number. I think it's 107,000. Okay, so you take the number of shares that you're going to buy, divided by that, and that gives you a percentage of shares that these guys will be able to keep. They'll be able to keep 62,467. But you take this number, the shares that Fertitta's going to buy, divided by the total number of shares that these guys own. That gives you a percentage to multiply each one of these shares by to tell you what they'll own afterwards. See how it goes down quite a bit? This is after the buyout. See, the total number of shares are the same, but Fertitta's go from 72,220. You add this 45,137, and now they're going to own 117,357. So they gain these 45,137 shares. These guys proportionally all lose that in the same proportion to what they owned. Okay, so that, and again, so now the company's value is the same because the number of shares is the same, the price per share is the same. It's just the ownership has been rearranged. These guys' ownership have gone down compared to where they were, and these guys, the Fertittas, have gone up, and these guys have stayed the same because they have the same number of shares. Okay, so now their ownership has gone down. They're getting paid for these, though. It's not like they're having to give them away. They get paid for them at that $155.08 per share. I could not get this up to 50%. I've tried several different ways because when you do this, buy this 23%, it dilutes that 26% down, or you could do this first and buy this 23% that they were going to buy, but it gets diluted when the 26%. So I cannot figure any way that it's going to be 50%. So I'm not sure about how to do that. I can't figure it out. But I mean, you'll be able to show him this stuff, and hopefully he gets a good idea that at least you know what you're talking about. Okay, so then this was the chart I was talking about. If you look in the case, there is a pro forma income statement. Remember, pro forma means before, you're forecasting basically. There's a pro forma income statement on page 22. All you care about is this top part, going to operating income. Because remember, this is earnings before depreciation, interest, and taxes. Okay, that's what the price earnings ratio is based on, your operating income. It's EBITDA, usually it's got A for amortization. They don't have amortization on here. So I just put earnings before interest, taxes, and depreciation, which is your operating income. Okay, so that's where I got these numbers from. So if you look, here's those numbers again. Right through here is that same thing I just showed you. Okay. Now we know that the shares outstanding are 270,824 once all the shares have been, when they invested the 11.2 million, that went up to 270,824 shares. And then of course when they bought the 7 million, they just bought someone else's shares, so the share number stayed the same. Okay, so earnings per share is just your earnings divided by your total shares. So that gives you your earnings per share. Now, they gave you basically the PE ratio for 1995 because we know that the per share price for that valuation was $155.08, right? And we know from this that the earnings per share is $8.12. So you just take this the price per share divided by the earnings per share, and that gives you the price earnings ratio. Price earnings ratio, right? This is the price, this is the earnings, price earnings ratio. That's 19. What I did was I ended up, now for other years out, you don't know what the price is going to be. So you know the earnings and the share number, so you know the earnings per share. You got to just guesstimate a PE ratio, which I made it keep going lower just to be conservative, because I kept it at 19, this value would get really high. So I just lowered it to be conservative. So you got your earnings per share multiplied times your price earnings ratio, and that gives you what the share price should be, right? Once you got the share price, we knew from that last exhibit how many shares each person owned, and then for each year you just multiply that times the price per share for that year, and that gives you what the value of the total value of all their stock is, right? And you can see it goes up quite a bit, because the price per share goes from $155 a share to $723 a share from 1995 to 1999 in 5 years. So the point is, you show this to the people saying, look, I know you got less stock, but for instance, Investor 10, your stock in 1995 is worth $281,000. It's going to be worth $1,300,000 in 1999 if we can do this growth with the funding for the Fertittas. So that's what you want to pitch to these guys, that even though they have less ownership, the value of that ownership is going to continue to go up because of the growth, because of the funding with the Fertittas. So that's what the whole case is about. Okay, if I can figure out how to get to that 50% ownership, I will, but for right now, I just have not been able to figure that out. Okay, hopefully that explains it to you.